Before I start this video with the technicals of what we're going to be doing and going over, I just want to remind you that I'm going to be walking you through my personal system called the LRS, Liquidity Reaction System, basically simplifying market psychology and basic understanding of liquidity. I like to not overcomplicate things. However, I do believe that in order for you to be able to simplify something, you need to be first able to understand the complexity behind it. Let's get the video started. So in this video, I'm going to be going over every single A+ setup that I have taken this month. I'm going to show you the tools that I use to spot high probability areas in where I expect or can anticipate smart money to react at, and how I trail my stops, how I maximize my profits and minimize my losses. I'm going to show you my playbooks that I use. Not all of them, but most of them have the same high probability confluences or combination of values. And if you don't know already, I post all of my trades on my X. If you want to give me a follow on that, if you click this link right here, you can access my free tools, my premium tools, and my free Discord community. So the first trade is going to be on June 21st, pre-market open, around 5 minutes before market open actually. Let's get straight to the facts, okay? The volume profile, I want to see where smart money was mostly positioned yesterday. So from the day started to where the day ended, that's where I know smart money was positioned at. So Fibonacci extension is drawn from the major swing high, the wick of it, to the first wick swing low in this case, which then broke opposite structure, right? Same for the standard deviation, it's a little bit different from the wick to the last series of candle bodies that got broken. The red lines that you see right here are where the anchors are at, okay? And every single red level that you see is going to be a quantic reaction level, where the algorithm is most likely to react because mathematically it makes sense, okay? So only pay attention to the red levels, okay? The Fibonacci extension has now hit 4.236. The standard deviation price has now reached 6 and 6.5. What else is in this area that we're looking at? Equilibrium level 0.786 and 0.618. Two golden pockets. Your golden pocket, it's right now these right here. Anywhere in this area, you should be interested in trading. And what else lands in this area? The value area low. So what does this tell you? What do the Fibonacci extensions and standard deviation extensions and equilibrium tells you? If you don't know what equilibrium is, then it's just, fine, I'll explain it to you. It's just where the market could retrace back to then continue the actual direction. In this case, a bullish continuation. So what do the Fibonacci extensions and standard deviation extensions tell you? They are telling you where this wave could extend to then continue going into the direction that the overall market maker model is telling you that it wants to go. So golden pockets identified, one asset that has a fair value gap, higher time frame, 15 minute in this case. What else is happening? We have just invalidated this bearish fair value gap. So we have an invalidation right there. Right there is when I entered. I entered on the same two contracts. My stop loss was at this protected low. And what was my target? My target was, it should have been just opposite liquidity, nearest opposite liquidity. That's a 2-hour trade. That's more than enough for me. But I'm willing to target this two right here. I'm willing to target these or these. Now, I could expect a retracement, so I'm not really willing to wait that long. Instead, what I'm going to do is I'll show you what I'm going to do. I'm going to draw opposite equilibrium. So now I know that the market could potentially, if bearish, right, we're going to retrace to equilibrium anywhere on these three levels and then continue going lower. Either way, I'm on the right side of the market because both moves make sense. Either this is the full bullish reversal or this is just a small bullish retracement to then continue going lower. That's looking at both sides of the market. So anyway, right, let's go ahead and play this out. I'm going to target 0.618. My R now increases to 3.0, I believe. Let me actually, okay, same 3RR, same difference. Patience. Right here, I would trail my stops. I'm not really willing because let's say, you know, imagine we had an SMT right here at this time. That's a bearish confluence. That's telling you perhaps we're going to reverse from here. And on top of that, we just reached equilibrium 0.5. So I'm going to trail my stops really aggressively to this point. Why would I not be willing to secure profit? Most of you secure profit, make it a risk-free trade by putting your stop loss at break even. And I'm just like, how does that make sense? You know, you're willing to secure nothing. Instead, you could secure 2,700 right now, bro, if you just trail your stop aggressively. And that's what I do. You know, you can go to my X, every single one of my videos. This is how I trail my stops. Okay, now let's see the next candle. I got stopped out and I'm fine with that. So now we get to the second setup. This one's on June 2nd. Once again, also posted on my X. I was able to make 1,600 on this trade. Now, very self-explanatory. And in this case, we have one of my favorite tools present as well, the SMT. So what do we got going on? Fibonacci extension, once again, anchored to the major swing low, which then started a bullish distribution. 6.854 has been hit. Standard deviation, level 6 has been hit. Level 6.5 did not get hit this time. What else is in this area? Equilibrium from the major swing high, which then started the bullish distribution and ended. This is the range that you're working with and not this range. Okay, we are at level 0.618. We are inside of the golden pockets of equilibrium. What else am I waiting at this time? Me personally, I want to see some form of internal sweep. What do I mean by internal sweep? I want to see perhaps a higher high being formed right here, sweeping the early shorts, and then continue going lower after that. So right now I wait. Oh, that played beautifully. We have a sweep, very valid. We had a change in state right here. We also invalidated this bullish fair value gap. And right now we are tapping back into it. Right there, I believe, is when I took my short. 2 contracts, as always, risking very little. Now, what are my targets? My targets are going to be these. Standard deviation. So I'm going to project where the market could potentially extend to using the same logic that I use to target my entries. So I draw my standard deviation. If this is my leg of structure, then I'm gonna anchor my standard deviation here, and my Fibonacci extension is going to use the same logic. So the major swing high, which now broke opposite structure, to the major swing, or the major swing low, sorry, to the major swing high, which then started, which it's about to start the bearish distribution. So now I look at my targets and then I try to see, do these targets make sense? Yes. They absolutely make sense. So I'm okay with just targeting this sell side, this sell side, this sell side. No need for me to get greedy. I could just target the standard deviation level 2.5. I'm fine with that. I'm only risking less than $500 to make 3 times that. Yes, I'm fine with that, bro. I mean, I could get greedy and target level 4 instead, you know, and target a big RRR. Me personally, I target always nearest opposite liquidity. In this case, I'm okay with targeting 2.5. Why? Because this sits just right below sell side liquidity. So I take that trade. After I see this massive sell-off, I would move my trail stops to this high right here, because I'm seeing too much consolidation. I'll continue to play it. Right here, I will trail my stops even more aggressively because I'm not willing for price to... Imagine we sweep this sell side, we don't even reach for 2.5 and then we reverse from here. I'm secure with just... I'm okay with just securing 1300. Boom, full profit. It's that simple, bro. Let's go back to the facts. 15-minute inefficiency, level quantic levels 6.854 of the fifth extension, level 6 of the standard deviation, equilibrium. We are inside these two golden pockets. We are around the middle of these two, actually. I bet you there's like a half point right here. What else happening here? An SMT at Asia high. Why? We swept Asia high on Nasdaq. On ES we didn't. We reclaim above previous week high as well, and then we are now rejecting from it. In here, we haven't even reclaimed previous week high. We had an internal SMT. Right here we had an invalidation plus a change in state. Yes, bro, that's a high probability area for smart money to then react. Also, something I forgot to cover, the volume profile. So same thing, the volume profile is drawn from where yesterday started and where yesterday ended. This is where most of the smart money is positioned at. Same thing, yellow lines, value area high, yellow low, value area low, green line, point of control. Look at what else aligns with this area. It's 2 lines. Point of control right here. The high probability area, the golden pocket, it's literally at the point of control. If you see all these bearish confluences stacked together, that's how you start tracking high probability scenarios. High probability confluences aligned together. Let's get straight to the next trade. So my next trade is actually going to land on the same day, just later on the session. Around market open, it's now 9:34. So look at where price extended after our projections were drawn. Price extended to the level 4. We reacted to it. We swept late shorts and then we have continued going lower after that. Now, where are we at? We are at the golden ratio 4.236. Standard deviation golden ratio 6, level 6. What else is left for me to add? Equilibrium. Where is my major range of equilibrium in this case? In this case, it's going to be from Asia low towards the current peak high. Now, this level doesn't align with this levels, right? So, where's my secondary major swing low, which then started a bullish distribution? Asia low, or sorry, London low. So, instead, I draw my equilibrium range to there. I anchor it there. Now look at what's going on. So we have an SMT right here. SMT with ES. Right now I just wait for bullish confluences. I want to see a strong buying force. I want to see the algorithm reacting to this high probability golden pocket. And now be aware that we had a trap earlier, a massive trap. So we had accumulation, manipulation, distribution, and now this right here was a trap. Why? Because look, market open, then boom, It took out every single early long in here. So I know that the next reaction, when it comes to bullish reactions, must be the actual move. So now I enter here. Stop loss goes at the protected low. So let's let it play out. This was a trap, clearly. Now I want to see strong buying force again. Okay, so that's another trap. Another manipulation wick. This wick got bought up, 941. So 3 more candles. This is the internal SMT that I'm looking for. So internal SMT, we have this candle having the lower low, and this has the higher low. That's the algorithm telling you on top of this higher time frame. So we have double SMTs. We have an external SMT plus an internal SMT. That to me is the algorithm talking to me. And now we just reached golden pocket 0.618 of the equilibrium plus 6.854 of the Fibonacci extension. Yes, bro. Now the golden pocket is no longer here, it's here. The standard deviations are sitting over here, yes. Because there's nowhere else to anchor them correctly. Because look at this. If I re-anchor them, because I re-anchor them once level 6 and 6.5 have been broken. In this case, we kept trading below them, right? So now I have to re-anchor them to see the other potential targets. I believe it's going to land around level 2 or 2.5. Perfect. 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 So I buy right here. Stop loss goes at the protected low. I target nearest opposite liquidity. It's still a good R trade. Take a long position. Let me see my RR real quick. 3R. That's more than enough for me. Same logic as before. I'm going to trail stop aggressively as soon as we hit into the equilibrium. In case I am wrong, you know. I've already been wrong once, and that's fine. Right here, I'll trail my stops. Actually, not yet. Right here, I start trailing my stops because right now I'm up 2,400. I'm okay with locking in. Where should I trail my stops? I'll trail my stops around there. That seems like a good point. Right now, the buying pressure is dying. Why? Look at this candle right here. It looks like a morning star or evening star. They're both the same difference. So right here, because I now have other swing points and other areas for me to trail my stop, I'm going to trail my stop right here to this wick, to the previous candle's wick. If I get taken out, I'm fine with that. I secure 2,500 in 5 minutes. Why would I not secure that? Why would I leave my stop loss at break even, bro, and risk the market reversing from this point to the and then continue going lower? No. I'm going to maximize my profit, bro. Perfect. Now I'll turn my stops to this previous wick. Now I'm securing 2,700. I got stopped out before going higher, and that's fine, bro. I don't need to be right about the entire move. I mean, it seems like I'm about to be right about the entire move, but I don't need to secure all the profits because I'm already maximizing my profit. Now, because I lost, what was it? Like 500 on the first entry. I'm only up 2,100 because I just made 2,700. But that's how you need to start thinking. I got trapped at this first reaction right here. Why? I was missing one of my confluences. The same confluence that I used in here. Remember, I was waiting for an internal SMT outside of the external SMT, and I didn't. But after I waited for the internal SMT to form, and then I enter on the changing state, boom, the market reversed perfectly from there. Right here, clearly I didn't follow my system. I didn't wait for the internal SMT to form. Internal SMT form right here. That's the algorithm telling you, hey, yes, it's me. It's me playing out right here. That's smart money telling you, hey, yes, we are in fact moving the market from here to here. On this setup, it's going to be a little bit different. It's going to be a little of a more advanced understanding of market structure while still using the same narrative with the Fibonacci extensions, quantic reactions, so on, right? So what am I looking at? First of all, I am looking at an extension towards quantic level 11.09, still aligned with the standard deviation level, in this case 6.5. I can identify my range of equilibrium. In this case, it would have been from this major swing low, which then started the bullish distribution, right? When it comes to equilibrium, we are at the 0.786. On top of that, we have an SMT currently being formed. So, golden pocket, it's identified. These two levels right here. ES is inside of a 4-hour, massive 4-hour fair value gap. In NASDAQ, it's currently bouncing or rejecting a 15-minute fair value gap. We have an SMT right here. We have what it seems a massive accumulation, manipulation, fake distribution, manipulation, fake distribution, accumulation. Now, the latest manipulation is playing out on ES because as you can see, we have a lower low right here. And NASDAQ has a higher low. So NASDAQ is a stronger asset. What else has just happened here? We have a 1 minute invalidation. So I was confident on taking this trade. I took a long around this area. Stop loss goes at the protected low. And then what's my target? My target is going to be opposite nearest liquidity as always. So not this one. Not this one. I mean, it could be for sure. It really depends on how much you're willing to, win in comparison to, or lose in comparison to winning. In this case, what made sense to me was the major opposite liquidity. In this case, 2,900 secure, risking $1,000. So I go to my long position. This is, I believe, a 3-hour trade, somewhere around there. Perfect, 3-hour, 2.63, basically a 3-hour. So I let it play out. Right here, I see a retrace. But then I see this massive wick. So, yeah, it was taking out early shorts, or sorry, early longs. But then this massive wick, it gave me the confidence that, okay, yeah, perhaps this is a bullish reaction, and this is the bullish reaction that I was expecting. So now I was confident in moving my stop loss to this point right here, because I know that it doesn't even make sense to come back any lower from this point. But if it does, then I'm going to protect myself against invalidation, as always. Okay, I didn't draw it, but my imaginary equilibrium, it's already drawn from, in this case, Asia high, which is, Asia is still developing. But this is my major swing high, which from, a key level, from which a bearish distribution starts. So right now we hit almost the golden pocket. But anyway, you get the narrative of what I'm trying to explain. Everything among my setups is exactly the same. Especially because I'm not going to draw my equilibrium range all the way from here to here, because that's going to take a lot of time for this trade to develop all the way from here to go from here to here or here or here and then continue going bearish or fully reverse, right? I'm positioning myself at high probability areas and extract profit as soon as possible. As always, that's your job as a trader. Right here, I trail my stops. I'll trail them to right here, this swing point, and I'm securing 1,300. And to be honest with you, because this is 1,800, I could be trailing my stop all the way to here. And honestly with you, I would be fine with that. I would be fine exiting right here, or the opposite liquidity, I would already be out. But I'm targeting that. And I am in fact going to trail my stops aggressively in this case. I'm fine with just securing 1600. So I'll see how that goes. Got stopped out. I secured a 1 hour trade. And I make fun of 1 hour traders all the time. It's all a matter of being able to adapt to what the market is providing you with. Past trades on this video, I have had high RR, small RR, 1 RR. I've been adapting to what the market is providing me with. I am not sold on, I only want to target 1 RR trades because that is all I am mentally capable of. No. I want to target high RR trades just because I want to feed my ego. No. I adapt to whatever the market is providing me with, bro. If that is a high RR trade, then good. If that is a small RR trade, then good. As long as I profit from it, bro, I'm fine with taking either one. So on today's trade, this is going to be, let me recall, June 4th. This is more of a, once again, understanding overall market makers, the psychology behind them, the actual draw on liquidity, and what needs to happen in order for the actual move to happen. This is the 15-minute, by the way. Look at what's happening on both of them. This is sideways consolidation. Where is the higher time frame draw on liquidity? In my opinion, at this time, it was previous week low. I mean, look how close we are to it. We have already swept the previous week high. Normally, we sweep one swing of the week, so previous week low or high, and then we trade to the opposite side of it, right? So, to me, from here, it doesn't really make sense to reverse bullish and then just continue going higher. If we want to continue going higher, it makes sense to sweep previous week low first and then reverse bullish. So what's going to happen on a sideways consolidation such as these? I'm going to expect both sides to get manipulated for then the market to provide me with the actual move. That's going to happen. In this case, we sweep, market opens at 9:30, we sweep sell side liquidity, and then we trade higher, we sweep this buy side, and then we sweep the overall consolidation buy side liquidity, which started right here. And on top of that, these areas align with a 15-minute bearish fair value gap, Fibonacci extension, golden ratio, and equilibrium range, which is from this swing high, not a key level, from which a bearish distribution started. So, and also this area aligns with a shallow reclaim. That's why in my indicator, I like to include even the key levels that have been swept, because the algorithm likes to react to them and use them as support and resistance. So once we reach that, let me go to the 1 minute. Excuse me, man. Oh my gosh. Okay, so now it's 9:37. It's 9:37 in here. I don't have an internal SMT. However, I have a bullish fair value gap right here that I am looking forward for it to get invalidated. Right there, it gets invalidated. 9:39, 9:39. Perfect. Just one more candle. On NASDAQ, we have a change in state. Right here. So NASDAQ is trading more aggressively than ES is. So would you consider this, if I want to target opposite liquidity, would you consider this a late entry? Well, let's see. If I sell, put my stop right here, and then I put my target right here. This is basically a 1 hour trade. Am I okay taking that? Yes, I am okay taking that. I mean, we have already identified the high probability area and the narrative overall. And like I said, your job is to be able to adapt to what the market is providing you with. Me personally, this is the market telling me that, yes, we do want to go back down here perhaps we want to keep selling off. And this is a high probability area from which it makes sense for the market to continue distributing bearish and target previous week low. So yes, that's a high probability trade for me. Right here, I'll draw my stops to this kind of wick. Or not the wick, the kind of body. Actually, let me move this to the wick. So this wick right here. I'm maximizing my profits. I'm locking in 1800 right now. I got stopped out and I'm fine with that. So I locked in how much? Less than a 1 hour trade. Or 1 hour risk reward. Sorry. That's fine with me. And you know, this might be a weird way of trading for you, but you know it makes sense based on everything that I have been describing on this video. I know that we could potentially revisit the changing the state of delivery area. The market likes to do that. We could revisit opposite equilibrium before continuing bearish. We have an SMT already settled. We have a double SMT right now. You gotta keep in mind the London high SMT plus now an internal SMT at the golden pockets. Plus a potential change in the state. Right now it's not as strong. You know what? Yes, I would take a sell right here. I'll take a sell, another sell right here. Stop loss goes at the protected swing high. You know, I could target all the way down here. That would be insane. But I'm okay with just the 1 hour. Or how about we pull our standard deviation tool so that we can see projections. And I need to go to the 1 minute. I draw my fib tool from here to here. We already revisited the change in state. Remember, this is a change in state. Let me label that so that revisit, so that you know what it is and you don't get confused. I could target these, which align with this sell side, or I could target level 4. Either way, both moves mathematically make sense. Trailing my stop aggressively. Stops go here. Stops now go here. Actually, I could be maximizing it, but because now I have a potential lower target, then I could go lower. Right now I got 3,200 locked in. Am I going to just leave my stop right there? No. I'm going to maximize my losses, or my profits, sorry, to 2,900 locked. If I get stopped out, which I most likely will, I'm okay with that. Boom. Securing another 1 hour trade. My initial target was hit. My initial idea was hit. I didn't need to be right about it going all the way here. If it goes there, then perhaps on a future trade, then I could be more patient with my trail stops. In this case, because we are in a sideways accumulation, and I know that we have just swept sell side, the market is more than welcome to reverse bullish from here. So this is a setup from June 10th. I'm only going to show you the A+ setup that you should have taken, because I don't always take all my confluences put together the same way, you know. I trade what mathematically makes sense. Normally I trade a pre-market open and at the market open, but market open and pre-market open, I had already missed this high probability area, and on top of that, this choppiness made me less interested, so I didn't take it. Instead, I waited for my targets, these projections, to be hit, and then from there I took my trade. So what do I got going on? And golden ratio 6.854 has been hit. Golden ratio 4.5 of the standard deviation has been hit. 4 hour bearish fair value gap, it's in this area. A 50-minute bearish fair value gap is also in this area. Do I have an external SMT? No, because both assets have swept Asia high currently. Okay. What else is in this area? Let me go to the 15-minute to see if I have some type of order block in here. That could be an order block. This right here, I have a different way of identifying order blocks. Bearish candle engulfs the opposite candle at a key level. Why is this a key level? This is a swing high from which a bearish distribution started. So that to me is a 15-minute order block. On top of, where is this order block sitting? In my golden pockets. Oops. Golden pockets. I could be interested in that, but I'm going to wait for an internal SMT to form, because otherwise I'm just guessing that this is in fact a high probability area. I need more confirmation than just a sell-off. Okay, I need to see an SMT. SMT. Oops. SMT. You always trade the weaker asset. Me personally, I prefer NASDAQ. Okay? What else is happening now that we have the SMT? Bullish fair value gap invalidated. Bullish fair value gap invalidated. A double invalidation. Plus an aggressive change in the state. I could either wait for a small retracement right here into this bearish fair value gap. I'm going to enter right here. I already got my SMT. I already got my golden pockets identified. Where am I going to target? Let's draw a projection, right? That's how we use these tools. Standard deviation goes here. Where could I target? Sell side. Perfect. Could I target level 2 or 2.5? I'm gonna target sell side. And I'm going to trail my stops really aggressively as we go down. If we go down. Trail stopping right here. No need for me to get greedy, but this is more than enough. I got stopped out, and I'm fine with that. I'm absolutely fine with that. So patience. Normally when I first started, actually explaining my system to the public, I wasn't really the type of guy to wait this long for my targets to be hit and then look for a trade. But the longer I continued to, connect the patterns, connect overall outcomes, the more patient I started being overall. And that's why I'm only showing you A+ setups. Like all the same confluences that I've been showing you have been present throughout all the setups that I've been showing you. So once again, on this setup, I'm going to conduct a quick technical analysis so that you can see my exact thought process at the time that I took this setup. Volume profile, same thing as always, start of yesterday to the end of yesterday. Equilibrium pockets, we are inside of them for sure. So now I have my fib extensions and standard deviations anchored. Same logic as I explained to you before. Major swing low that broke opposite structure. Candle series of candles which this side broke. Golden pocket identified. What else is in this golden pocket? A 15-minute fair value gap. What else is in this golden pocket? Equilibrium. So let's include the equilibrium range in this. Does it make sense to perhaps come down and sweep Asia low before the major move happens? Yes, it makes sense. Now, is that enough for me to actually buy into it? Let's look at what happened. Let's go to 934 in here. $31, $32, $33, $34. Yes, remains the stronger asset. The SMT is between these lows. So I have an SMT here. What else? Equilibrium range no longer matters because it has been taken out. Now, what's my next range of equilibrium then? Major swing low from which a bullish distribution started. Golden pocket now aligned with equilibrium 0.618. Where is the market right now? Right there. What else is in this area? Let's go back to the 15-minute. 15-minute fair value gap has not yet been invalidated, I think. There's another 15-minute right here anyway. Let's go back to the 1 minute. This is remaining the stronger asset. Perhaps we are targeting previous daily high. We already had a trap right here. Accumulation, manipulation, distribution, fake distribution. Boom, we reversed. 930, swept these early longs. I'm interested in trading these. So take a buy right here. Stop loss goes at the protected low. Where's my target? Opposite nearest liquidity. Could be that. Could be that. Could be that. I'll target these right here. The major opposite liquidity. And then I throw my stops aggressively. Once again. I could move my stop losses to break even because, you know, I'm okay with just securing that 1600. I could trail aggressively, right, like these or like this or like this, right? I'll be more patient this time. Right there, I move my stops right here. Because I'm not interested in consolidation. I'm interested in perhaps securing profit, so I could be moving my stops to here. You know, for the sake of this video, to prove a point, if I get taken out, then this is what I mean. I could have secured 1500 right here. Instead, I'm going to be like, you know, most traders, basically break even, see what happens. You see? You see what I mean? You see what I mean? Well, let's look at what actually happened, okay? Let's see what happens after these. You see what I mean? You see what I mean? Now, I could have secured 1600 or be patient about it and wait, you know, for the actual move to finish. To me personally, it would have made sense to just secure the 1600 instead of, you know, waiting for all of this to develop. But, you know, once again, this is a personal psychology approach. Me, I want to get out, I want to enter and get out as soon as possible. Your approach towards the same psychology perhaps is different. All I am showing you is high probability areas in which the market is most likely to have a reaction at. Your job is going to be to align these tools with your way of trading. At the same time, obviously, I'm going to provide you with, hey, here's the way that I think you should do it. However, I'm going to be 100% honest about it and tell you that your actual goal should be to mix these together with the confluences that you are already using. And if the confluences that you are already using are too complicated, then this is the way that you simplify it. This right here is simplification. What am I looking at? Liquidity, inefficiencies, fair value gaps, they're both the same thing, okay? Liquidity or fair value gaps are liquidity. So key levels and fair value gaps fall under the same category, liquidity. So realistically, all I'm looking at is three things: standard deviations, fib extensions, and equilibrium. If these three align with liquidity, and on top of that, I have SMTs telling me that there is, in fact, the algorithm creating divergences between two assets, then that's a high probability area for me. Once again, I really hope that you have found this video useful. I love making this type of videos. It helps me build my own muscle memory. And don't forget to join my free Discord community. I love everybody in here, even though most people don't even say anything. It's free to join. I share a lot of my tools. You can access my tools once again on the link on my profile on my X. If you want to see me post all the trades that I take and useful information, and seeing me make fun of 1 hour traders, go ahead and follow me on my X. I really hope that you have a good rest of your week. Keep in mind that it's the end of the month, so high volatility is expected. And once again, good luck. I ran out of things to say.